Niël Pretorius. I'm the CEO of DRDGOLD. We're a South African-based gold producer, and we produce gold from old mine tailings.
Yeah, good to have you here
Nice
in
to be-
London.
Nice to be back.
You're taking a little bit of roadshow. We're sort of here for the kind of one-to-one conference, but you're not taking part of that because you've got your own lineup, and you're meeting a lot of, I guess, institutional investors over here.
Yes, we will be meeting 3 or 4 institutional investors over the next 2 days.
Yeah.
So came here for that.
Are they a little bit excited about the gold price?
Well, the gold price has been behaving really well for us, but then also there's a bit of volatility in the gold price. I don't know if you saw the markets on Monday.
Yes. Yeah.
So it was a bit of a bloodbath for gold stocks, but I think that's just where it is at the moment. We saw I think a 5% gain, our stock a 5% gain on the New York Stock Exchange on Friday, and then over the weekend there was talk of the Ukraine and Russia, their presidents meeting in Turkey. There was talk of an agreement between the United States and China, and then suddenly, all the world's problems are solved. So the gold price goes down 3%, and most gold stocks went, I think, lost about between 7 and 11% on Monday. Seem to have settled down, but that's the reality now. It's still really high though.
Yeah.
Much higher than I thought it was ever going to be, but so it's still a very good gold price environment.
Good. I was about to say, a year ago, you'd have bitten someone's hand off for this price, wouldn't you?
It's fascinating. There's one of the better analysts in South Africa changed his outlook, his gold outlook, about 2 weeks ago.
Mm-hmm.
He's got for the rest of the year. His outlook was $2,300. He's changed it now to $3,200. So he swapped the 3 and the 2 around.
Okay.
$1,100.
Because I think consensus is sitting around 2,400, certainly up until a week ago, before China and the US kind of got together again. Yeah, no, look, I think the point is, it's interesting times. I don't think anyone realistically expects this thing to be carry on shooting up the way it has for the last 18 months. I think that would be wishful thinking. But nevertheless, you've got to take advantage of these prices when they happen. And you guys seemed to have made your minds up to do that. Can you maybe talk about what's going on at Ergo and some of the changes to the plans?
Certainly. So we have 2 operating units. We have Ergo, which was the one that started off 2008, and that's one that sort of led our transition from deep level underground mining into the surface, exclusively into the surface tailing reclamation business. That project, or that business unit, had a life of mine of 12 years. We motivated the initial capital investment into Ergo, the acquisition and the capital investment, on the basis of a 12-year life of mine. And that 12-year life would have expired 2 or 3 years ago, thereabouts. And at the time it became apparent that the gold price environment has definitely changed, and it seemed to have changed for the long term. It just seemed stronger, and the dynamics driving it appeared to have changed compared to what they were a decade ago. So the decision was taken not to go into closure, but to rather look at ways and means of extending the life of Ergo. So the decision was taken that we are going to extend the life of mine, and we decided on a capex reinvestment program involving, firstly, building a solar farm, because that's one of the major cost drivers for Ergo. It's a massive operation. At the time, it was still doing 2 million tons, processing 2 million tons of slime per month. It's now cut back to about 1.6 million tons due to the condition or the remaining capacity on its remaining tailings storage facility. But power was a big issue, so we decided to invest in a 60 megawatt solar power plant, coupled to a 180 megawatt battery energy storage system. That's all been done. And then over the next few years, it's got to build that tailings facility that's going to extend its life. So as we phase out of the current tailings facility, we go on to the next one. So that's sort of, in broad terms, the plan for Ergo, and to extend its life to beyond 2040. The same applies to Far West Gold operations, except that's the one that we acquired from Sibanye-Stillwater a few years back. That is a fantastic business as well. It's much smaller. It's running at 500,000 tons a month. That operation always had the second phase as part of its longer term plan. and we're now implementing that second phase as well. And that too involves the construction of a very large tailings facility. We call it the RTSF, or Regional Tailings Storage Facility. Once it's completed, it will be able to, over several decades, in fact, receive north of 800 million tons of material. We only have about a 250 million ton resource there, but it was built specifically to provide a longer term solution for that entire region. And then its plant is being doubled in size, and that's actually going quite well. It's going to go from, it has a 600,000 ton a month capacity. We're running at 500,000 tons a month. That needs to go to 1.2 million tons.
Right.
And so both of those two, that's really the focus areas for the business at the moment, is to get the to reinvest the capex that will take us to that throughput profile. Okay. The idea being that in 2028, financial 2028, that we have throughput capacity of 3 million tons per month, and that the combined production, the combined output for a business is about 200,000 ounces per annum.
Right. It's going to be a slight segue in a way, but it's just trying to understand some of the decision-making process. Like say at Ergo, given the nature of what you do, it's effectively it's a kind of massive, not only getting ounces out of the ground, but you're remediating the ground. So you're processing these big tailings. With a normal mine, if they have to remediate, there's a kind of a huge and large inherent liability and cost to doing so. For you guys, are you sort of doing this as you go along? So that the actual, if you say, well, we're going to close this mine down, is there a big cost to it compared to conventional mining at the end of the process?
No, there's a big difference, in fact, because typically what most deep level mines do is that they're very good at containing the impact of their operations during the course of the life of mine, but there's still this large liability that looms at the end of the operation to bring about the final closure, the rehabilitation and closure of the mine. And it's not something that the industry has been particularly good at doing, especially in South Africa. There are many old skeletons of former mines that have just not been properly closed and rehabilitated. Yeah. The process that we're following, and that's the nature of the business. It's not because we necessarily have a different value system. Obviously, there's an outcome that we want to achieve, and we hold ourselves to a particular standard, and that's driven by the value system or the value set of the business. But the very nature of our business is by moving these tailings, by picking them up. The business is waste neutral, so we don't generate any new waste. We take old waste, we reprocess it, and we put it onto a tailings dam, a tailings storage facility that is managed to a different set of environmental standards.
Right.
That I think that probably more in line with what restoring the ecosystems, what that looks like, etc., etc. So it's the areas where the material is being lifted from, those get fully rehabilitated, and it either goes back to the way that it was before there was mining, or it's being put to use. It's been
so there's no big sort of chunky OPEX requirement or bond required at the end of a project like this. You do as well.
No, you do,
but it's a different quantum.
Yes, no, it's actually also still quite large. You do need to provide for premature closure. So if the business closes tomorrow, then you've got 4 or 5 different sites that have only halfway mined. And then you need to have adequate cover to actually go and responsibly close those. We don't stop halfway through the mining of a tailings dam. We mine the entire thing and we close it down, and once that is done, then the liability, the exposure is significantly lower than what you would find in a conventional mine. But if you stop prematurely, if unplanned closure is the term that's used, the technical term, then it could be quite large, and as a consequence we have several hundred million rands in rehabilitation funding and in guarantees that could be applied towards that. Obviously once it's all done, that would be a nice surplus.
Okay, interesting. Okay, so let's come back to the decision making around the extension of life on Ergo, for instance, right? You're looking at gold price today, but you're going to have to take a sort of long-term view as to what some sort of consensus price will be for gold and what that does for your business, to work out how much new capex is required to extend the life of mine and how long that will extend it for, etc. So can you talk us through some of the thinking, the rationale that you went through when you made the decision to do that with Ergo?
Look, the advantage that we have is that we have an established plant and we have an established network of pipelines, and we own all the resources that we require in order to see this life of mine plan through. So ultimately, really what you do is you look at the capex to expand into a particular, or to bring a particular new dump into your reserve base, to link that up with your system.
Yeah.
So you don't have to, again, go and spend 3 billion rand on building a plant.
Yeah.
Obviously, the work that we've got to do in order to create additional tailing storage capacity, that runs into the billions. The electricity, the solar farm that we built, that ran into the billions. That was 2.9 billion rand.
Yeah.
But the fact is, you have an established network, you have an established infrastructure. So that's really capital that's available to be used and to be applied also. And that drops your capital threshold in order to access new resources. So ultimately, you really do it on the basis of what is the potential revenue per ton from this particular resource.
Yeah.
What does it cost to link it up with the rest of the system?
Yeah.
And obviously you discount that over the life of that particular project, and then you look at what your cash costs are going to be. And those margins are attractive because the gold price is just so much higher than what it used to be.
Actually, we should remind, because you've got a record quarter just gone. So can you remind people and people new to the story, those sorts of top line numbers are?
No, certainly. Look, we at the end of the first half of the financial year, we did in fact have a record first half, because of the much higher gold price. We thought that we were going to have to dip into the facilities that we secured to help fund the capex, and we didn't. We in fact declared a dividend, and we still had some cash left in the bank. South Africa's had a particularly wet summer. January, February, March were particularly wet, so we've seen some disruption in throughput, and that's had an impact on output for the last quarter. But still, despite that, the gold price has just been so much higher than what we had planned for, that underscored our budget, that the numbers still look pretty good. So we're in a position now where we could really reinvest all of this capital without having to dip into the facilities, because the assumptions are just so much different. However, it's gold, and gold is cyclical, and we take full exposure to movements in the gold price. We don't hedge. And I made the comment earlier, you see what a 3% movement in the gold price can do to market sentiment. It could get actually quite ugly quite quickly. So we believe that we've got to spend this capital now while we can to get the system up and running. Because once it's there, it's pretty much like a factory. We're working our way through a stockpile. If you really want to reduce it down to very, very simple terms. And you want to make sure that all the capital infrastructure that you have, that you need in order to do this efficiently, that's in place as and when this margin starts shrinking again, because it will. It has to. It always does.
Right. But you still, like I said, you mentioned it, you're still managing to pay a dividend. Would you pay a dividend if you would have to dip into any of the facilities that you're going to use? Because obviously the cost of borrowing is going to be cheap for you. You're a producer. It's flowing. I don't think you'd have too many problems there. But would the dividend ever be stopped in that kind of scenario?
So
you've been paying it a while now, right?
We've been paying now for 18 years. It's for 18 years that we've been a dividend-paying company, and for us, that's an important. It's almost become a value more than a policy. Because we believe that business. You're in business to make money for your shareholders, and there's no better way of demonstrating that than by giving them some of your proceeds. So it may be naive, but
what does it look like as a percentage? I mean,
well, at the moment, the share price is actually quite a bit higher than what it was a few years back. So it's probably about 3% at the moment, but it varies between 2.5% to 5% thereabouts, depending on what the share price is. Dividends been relatively consistent the last few years. We've had a very good last few, let's say 4 or 5 years, with the gold price being so much higher than what it was in the previous 10 years. I mean, we had some moments in between 2008 2016. There were times when we really didn't know if we were going to make payroll the next month, more than once. So it's not always been this pleasant.
Here we are.
It's been
30 years later.
30 years later, we're still around.
Yeah.
People ask me, so how are things? And I say, tongue in cheek, no, well, we're still making payroll.
Yeah.
It's only partially tongue in cheek. There were times when we were really battling to make payroll.
Yeah.
But the fact is, this business is one where once you've set up your infrastructure, your stay-in business capex is only about 5% of your cash operating costs. So you want to get to that point sooner rather than later.
Yeah.
And the model is sound. The return on capital is significant. It's definitely justifiable, and it's just, I mean, we don't want to not take full advantage of our ore body. There are a number of principles that we try to apply in the business. The one is that you've got to optimize your ore body, and if you're in a position to do that, especially if you're in a cyclical business, at some point you've got to believe the data, and you've got to believe that.
Talk about this, because it's not conventional mining. So we say you control the ore body. Obviously, before you start processing, what are you doing?
So in other words, we've got 6 million ounces of gold in our world, a little bit less now, but it's thereabouts. It's sort of north of 5.5 million ounces.
It's a big deposit, should we say?
It's a large deposit. Yes, but it's in waste. It's contained in waste. But that is what we have. That is our primary asset. It's the gold in these dumps.
Yeah.
And I think that you either mine it, you optimize it, or you get away from it. But you don't just sit on it. And so I think we are duty bound to optimize that ore body. And you got to take a view. You're in gold. It's like being a farmer. You're not a farmer unless you believe it's going to rain in time for you to have a crop. And the same applies to gold mining. Obviously, you're not going to be stupid about this, but you've got to believe that the dynamics. You've got to have a view on what the dynamics are that drive gold, and then you've got to believe those dynamics, and you've got to act accordingly. You're never going to be 100% certain of. You're never going to 100% de-risk a gold mine. That's fixed income. That's not mining. Mining means that there are certain contingencies over which you have no control. You've got to have a view what those dynamics are. They've got to be intelligent. There's got to be an intelligent view, not fanciful, not conspiracy based, but I mean, there's genuinely a lot more fiat currency units in the world relative to the amount of gold that's out there, physical gold that's out there, compared to what the situation was 10 years ago, et cetera, et cetera. So these are typically the dynamics.
But explain it, because I think people are, okay, you've got a deposit, but it's sitting above ground. It's already been mined, it's sitting at the ground, and you've drilled a few holes, you sort of know roughly what the grade is on the various piles, et cetera. So when you say, when you're trying to optimize these things, this is a massive engineering exercise. It's about efficiencies, because the grades, it's already been processed once, so you're processing it again. So you've got to be super, super efficient. So in terms of the skill sets required for that, do you think these sort of new additions to, I'm sticking with Ergo at the moment, do you think the new additions there to the plant machinery and process and flow sheet will allow you to continue to improve efficiencies around recoveries? Or is just are we expecting more of the same, but maybe processing more? I mean, where's it come from?
So optimizing your ore body means that, remember, the grades are different in all of these dumps. Some of them are higher grade, some of them are lower grade. Optimizing your ore body means that you mine a blend that will give you the best possible chance of mining as much of that resource as you can. So instead of just mining a third of your resource and look really good in over the next 5 years, you mine all of it, and you might not look as good over the next 5 years, but you're going to be around for the next 15 years, and all of that gold will have been mined. And somewhere in someone's investment portfolio, in his portfolio mandate, the sort of returns that you offer will be a fit for that portfolio mandate. You're not going to please every single gold investor that's out there. But you've got to be truthful as to the quality of your ore body and say to them that this is what we're going to be doing, and this is the potential. This is what we offer. We take full exposure to the gold price. We're a relatively high cost producer compared to other companies that do primary mining that have high quality ore bodies. And we're going to be mining this entire thing. We're not going to be favoring certain parts of the business, different points in time. So the predictions, the forecasts are relatively flat. Factor that in. If that fits your appetite, if that is consistent with your portfolio mandate, or whether it's for clients or whether it's self-imposed, this is the stock for you. But it's not.
So it's low risk, but the margins are tight, but they're consistent. And you said
not necessarily low risk, but hopefully fewer surprises.
I guess that's what I'm getting at, because it's like you're not sort of having to hunt down the ore body, the gold underground,
No.
and chasing it with its high grade.
You're just got to move it at the right pace. And I mean, what we saw, for example, in the
Right.
3 months up to March, is when the weather is bad and you can't access certain sites, and you can't get that blend spot on. You see it in the grades, and your gold production is lower. But those are the contingencies that we've got to deal with. The one contingency that we don't have to deal with is falls of ground and seismicity and all sorts of other interruptions due to the fact that you're 2.5 kilometers below surface. That's something that thankfully we get to avoid.
Yeah. I guess people is always a factor in this. I think you're very proud of, and certainly comes across in your marketing material, but also in the conversations we've had over the years, is the brand. We operate to higher standards. Because I did kind of pick up a company last year. They've had a lot of, I say on a quarterly basis, they are announcing some kind of incident, deaths or otherwise in their minds. I think that is something they definitely need to address. But for you guys, you work to a certain standard. You're proud of the people. You train the people. It's relatively simple mining as well, so that also helps. But are you finding enough people coming through? Are we able to kind of maintain the amount of staff that you work with?
It's actually very exciting now that, a few years back, when I say a few years back, remember I've been around 20 years with this company. Yeah. If I say a few years back, it's 10 years and more. But we were old, or we were sort of all of the same age and getting older. But there's so many smart, dynamic young people coming through the ranks now that chose to join this company, and they're starting to make their mark.
Yeah.
And it's wonderful to see how they develop and how they're making it their own.
That's why I ask, because like we talked earlier, it's 130 years, right? The company will evolve and change and rediscover itself along that journey. Like I said, a few years ago, where are we going to make payroll? So you have to evolve and change. That's why I think that, is there youth coming back into this?
Yeah.
Do they want to be trained for this? They see us as an opportunity,
Definitely.
Or is this an old man's game?
No, definitely no. They keep us on our toes. We've got a lot of younger people coming through the ranks. I think up to close to half of them are women.
Yeah.
Which is also, it's very exciting. They work hard. They take ownership of the business, and these are women in some of the hard portfolios. We've got metallurgists, geologists, so forth coming through the ranks, environmentalists. So it's nice to see that, and it's when you get sort of towards the latter phase of your career. Mine, as I say, I'm 58 years old, so I'm probably not going to be around for much longer than another 3 to 5 years. Hopefully they'll have me for that. But it's nice to see how the next generation of leadership is positioning itself and how they're developing.
Yeah.
And to hear what they say about the future for the business, and to hear the value system that we try to live, and the broader strategy that we're pursuing around sustainable development. That's become part of the everyday narrative amongst my older colleagues, as well as some of the youngsters coming through.
Why aren't there more companies like you guys? There's not a lot. I mean, we talked before we started filming. Just a couple of names, but one in South America, another one doing some stuff in Botswana. It's you kind of think we need more of this. But it doesn't seem to be coming through. So what's stopping people?
I think we were very fortunate. In the first instance, we've had I know that corporate governance requires that you change your board members every few years and so forth. We're very fortunate that we had a very consistent board for many, many years. Jeff Campbell, who's from the UK, was our chairman for most of my career, and he handed over the reins to Tim Cumming, who's from Sibanye-Stillwater, but he's been around a long time. So also somebody that's a seasoned operator and corporate player. But we've had the benefit of consistency from the board. You don't have to change every few years. We've been allowed to fix our mistakes. And something that I think the people that are with the company now and that have taken it from where it was, or be part of that journey, and let's rather say that have taken advantage of the change in circumstances and position the company to to really move forward and take advantage of that are the same people that I met when I was appointed in 2008. They were there.
Okay.
And somehow it's almost though the value system maybe was a little bit different at the time. And I think the point that I'm trying to make is that the people who are there, the values are there, the potential is there. What you really got to do as a corporate is just create the space.
Yeah.
Say to them that you're here for a purpose. There's an opportunity.
Yeah.
Pursue it and not run it like it's your toy. Not run it like it's
Empower them. Empower them.
Yes.
Okay.
Yes.
Okay.
So I think the values in the business were values that the space was created for existing values to really become deeply embedded and universal. And I think one of the values that you do witness among staff, management all the way through, is, and I believe this because I witness this, I see it and I hear it in the languages, is purpose beyond oneself. It's that sense of responsibility, well, towards oneself, towards one's colleagues, and also towards the company. And the company almost, the company interests and personal interests becoming aligned, but in a positive way. And that the space was created for that, because I think because of the culture from both the board and hopefully also from the executive, and people are taking advantage of that. So the anxiety of having to deliver towards or perform sort of your short term. There's no razzle dazzle. We're not chasing short term goals.
Stick to the knitting.
We want to be around for, the company's been around 130 years. We took the decision that we want to optimize this ore body, mine as much as we possibly can.
Yeah.
The place must look like, must be in a certain condition once we're done. That must be evidence of our presence. And we're not going to change that. We want to be around in after 150 years as well. There's another 20 years and doing the same thing.
Okay, so let's just kind of look to the future then. So we're saying we're still dividend paying, we're self-funding on the capital expansion program, and we will be obviously the asset you picked up from Sibanye-Stillwater is super. We will be efficient there as well. We will produce more ounces, and we will hopefully this gold price goes on as long as it can. But if it doesn't, we're prepared for that, and we can still make money. So, what are we looking forward to in the rest of this year from you guys? What are we going to hear from you?
So we really want to make sure that we stick to the program with regards to the capital reinvestment program that's happening. It's taking up a lot of time. There's got to be focused. This tailings dam that's being built is probably going to do one of the largest ever that's built on a synthetic liner. It's a center line downstream dam. It's going to be done properly. It's going to be done carefully, properly, but quickly, because we're up against a fairly challenging timeline. We want to get that in place. We want to make sure that the plant's in place and everything else that needs to happen around Ergo as well. We need to make sure that we keep a pace with the program so that we can hit the ground running in 2028, financial 2028, that we can get both this throughput profile and also the output target that we've set for ourselves.